Now, without further ado, I will introduce our moderator for today's session. Chris Casacchia is editor of our MJBiz Retail and Brand newsletter and is also a seasoned cannabis reporter from Long Beach, California. Welcome, Chris.
Thank you, Kelly, for the awesome intro. So happy to be here today. Super excited to be talking about facts about cannabis. We have an excellent all-star lineup today. Andrew Long, our data reporter, is going to kick it off, and we're going to talk about the fact book, what goes into the fact book. I mean, we are talking about months and months and months of work that the editorial department does, and Andrew does a lot of this work. Then we're going to switch the conversation to talk about Ohio. All eyes are going to be on Ohio next month. It is, potentially the only market that we may have in the United States that's going to be opened up as a new market this year. They got a key legislative approval yesterday that puts everyone on pace to open sometime next month. We're going to have Headset CEO and co-founder Cy Scott talk about the Ohio market in detail. He's going to use a little bit of Maryland as a comparison, since now Maryland is almost a year in the books in terms of opening up their rec market. We're going to touch on Florida, obviously a crucial state in an election year, but of course, they will be voting on adult use cannabis as well there in November. Right now, it is the only state that I believe that we have that's going to have a ballot referendum this election cycle on cannabis. We're going to close up the discussion with Viridian Capital Advisors Managing Director Frank Colombo. We're going to talk about the capital markets, how dry they have been, how rescheduling could at least affect, certainly the taxes and balance sheets of a lot of publicly traded companies more so than others, and how that may bleed into possibly some M&A activity if they get, some more cash on their books at the end of the year. And then we're going to open it up for a short Q&A at the end of the conversation and open it up to folks that are listening in. So without further ado, we're going to bring in our data reporter, Andrew Long. And Andrew, please tell us about the 2024 edition of the MJBiz Factbook and what readers can expect when they open up the digital edition.
Yeah, so for those of you that aren't familiar with the Factbook, it's something that MJBizDaily has been putting out for the last 12 years. This is the 12th edition. It's really a team effort. All of our reporters that you read every day, our designers, our editors, we start early in December and start talking about what's going to go in it, what are the news items, what did the year look like, and then we work with our data partners to put together a review of 2023. That's what the book is, even though it says 2024. This year is especially interesting because we've decided to change the way we're putting out the book. It's always been a yearly thing where we drop the book in March or April, and then we try to sell it the rest of the year. The data gets old and stale, so we've decided to go to a different kind of model where it's more of a member program. It's a membership, and we feel that way we can keep the data fresh all year long and keep in touch with people who are interested in this. And there's certain, as you can see by the slide, certain benefits attributed to the different levels of the fact book. There's just the facts, if you just want the fact book. There's the critical insights, which gives you a little bit more. We're doing a live webinar like this every quarter. We have a library of MJBiz reports. And then as you get into the industry insider, we also do a chart pack every year with all the charts. We did 49 charts this year in the fact book, and those are all available for you to use for your private use with the chart pack. So it's kind of an interesting thing we've tried to change to allow us to update the data. We couldn't do it without our partners. A couple of them are here, Cy with Headset and Frank from Viridian. We also partner with Brightfield, CRB Monitor, and Cannabis Benchmarks. So, it's 8 chapters this year, 8 chapters, 200 pages. I'll say 50 graphics because I'll round up. We also, the core of the fact book is also our state by state, which is we go med and rec and talk about the regulatory, the taxes, all the stuff you need to know about those markets. The updates are the cool thing. The next one will be June 10th, and I'm working on Canadian and international data. So we'll be putting that out coming soon. And then after that, we're going to go into a jobs. We're going to drop a jobs section that talks about what's going on in the job markets and that kind of stuff. The fact book, what is it? The core of it is market projections. We also do data roundups. And the other thing is our survey. And we do, I think, a large survey we have a pretty good mailing list. So we had between February and mid-March, we asked anybody in the cannabis industry questions. There were more than 600 qualified respondents. The cool thing about those is 90% of them are owners, founders, or executives. 72% operate in plant touching businesses, cultivation, retail, distribution, manufacturing, processing. The rest are ancillary. So that's products and services, the media, associations, and those kind of stuff. We ask from everybody. Most of them are from the US, but we do have some international respondents. So if you go to that next slide, I just wanted to bring a couple of slides to talk about some data that we got from the survey, because I thought they were kind of interesting. One of the questions we've asked every year is, what is your overall look for the cannabis industry over the next 12 months? And I found this chart kind of interesting because you can see how people's, what their outlook is changes as they get into the business. So we asked people who are planning. So these are people who are just early in the stages of getting into the cannabis industry. Then we go to pre-launch, which they kind of have a detailed plan. They have a date for launch, and then we go launch. These are people who are generating revenue, and then close, people who no longer are generating or shut down their business. And if you look at the green bars there, you can see that those are the ones that are much, they think the industry is going to get much better or somewhat better over the next 12 months. And you can see how that percentage kind of changes as people realize that the market, the industry and that are probably a little bit tougher than they had anticipated when they were starting to launch their business. So this is one of the interesting things that I found. The launched or generating revenue, 48% thought things were going to get better in the next. And this is also before the rescheduling information, that came out. So this was before that happened. So things probably have changed a little bit. But if you add that gray bar, which is about the same today, about 80% of people who have launched businesses think it's going to be the same or better. So let's go on to the next slide. And this is one of the things we asked people is, was their business profitable in 2023? 53%, and this is plant touching businesses, 53% said that they were profitable, while 32% said they weren't, and 15% said they broke even. What I found interesting about this was that while fewer people reported that they lost money, the amount of the percentage of their net loss was higher. So you have 42% of those who said no actually had quite a considerable amount of loss, more than 20% loss in their business, whereas those that were profitable, it's still kind of in that middle range, 5 to 20% kind of deal. So it's just an interesting look at who's profitable and who's not. You can go to the next slide. This one is, we want to know what the challenges are, because it's what helps the industry. It helps us understand what they're facing, and what it informs our what we write about and what we do, that kind of stuff. So it's interesting that the cost of complying with regulations was the highest concern. So if you look at the next couple, it's federal laws, it's intervention, it's taxation, more so than the fundraising or the competitors or even inflation, which is down at 6% that responded, thought inflation was a big challenge. So seeing, where those are lower down or finding employees, differences of opinion with the decision makers in the organization, and declining demand. So the government still is a big challenge for the businesses in cannabis. And let's go to the next slide. Now we work with a bunch of partners. The one thing that we like to do is we like to take their data and help visualize it and round it up so that you can easily understand what's going on. One of the new partners we worked with was CRB Monitor, which tracks licenses and licensing. And I just wanted to compare these kind of two charts over the last 22 to 23. This is the number of licenses that they have tracked for cultivation and retail. And you can see there's a definite decline in cultivation licenses. We see this in some of the people leaving states like California and closing down cultivation. But yet retail is kind of growing, but is still kind of somewhat stagnant as far as there was a kind of a bump in Q2 2023. So we can kind of see where the licenses are and the trend at that. And the reason that I bring this one up is the next slide there. The interesting aspect of the US versus Canada as far as cultivation, the ratio of cultivation to retail licenses, I think is really interesting as far as the cannabis market is. In Canada, cultivation licenses only account for 19% of the two types of licenses. So if you combine cultivation or retail, 19% of them are cultivation, whereas in the US, 61%, which is just a large, the ratio is probably off as far as and we see this in overproduction, prices dropping, and those types of things. And I just think this is what makes the fact book interesting, and what I enjoy doing about it is just seeing these kind of trends by putting these the data together. Back to you, Chris.
Andrew, maybe just talk about, have you seen shifts in the last few years in terms of hold on, let me just bring out my video. In terms of what the biggest challenges that businesses look at, have those changed, those top tier concerns? And then also in terms of, profitability metrics, have those also changed? Because there's this idea, a prevailing thought that certainly cannabis companies are losing more money now than they were before, but I'm not sure if the data actually, rings that true.
Yeah, I think the government has always been a top challenge for people, but I think earlier on in the data, a few years ago or several years ago, it was more the illicit market. It was everybody was thinking they were competing with the illicit market. I think, and this is as a survey, you're asking people, there is this thought that the government is in the way of what they're doing. So it's the taxes, or even at the local level, where you can have your business, where you can, one of the things when we put together the state by state, I get to read all of the restrictions that the states have for certain things, and some are worse than others. Some are good markets, some are bad. So it's just kind of the shift. But I think, I think it's settling down into some of the things aren't as much of a concern anymore. The illicit market. I think finding employees was a tough thing at one point, but I think that's as it becomes more as a stable and sustainable thing, that finding employees is easier and easier.
Yeah, that kind of jumped out at me, and of course there is some bias when it comes to answering these types of surveys, or maybe you don't want to be,
Yeah, I mean,
Call out your own problems, right?
yeah, who's going to say the government is doing a good job?
Yeah.
But there are some states where I think some things are better than others, but there's probably always something there that is interfering with these cannabis companies.
Yeah, and in terms of the illicit market, obviously we have big concerns out here in the West Coast, kind of like legacy markets almost, I mean, established markets, Washington's, Oregon's, Colorado's, California. The newer markets, obviously New York, we know what's going on there. We know there's an insane amount of, illegal retailers there, but it's certainly, we're not seeing that type of development in other new markets like New York. I mean, I think that's an anomaly, in modern times.
Yeah, and every state is completely different, and I think that changes. I mean, I think California, it depends on what the state is doing with the illicit market. Some have jumped in and started doing more about them about that, and some aren't. So
yeah, absolutely. Well, Andrew, really appreciate you taking out time and wrapping this up in a nice little tidy summary for everyone. Highly recommend, go out there, buy the book, stay updated. I mean, this is the best resources for looking at state by state comparisons, international. And now we're kind of, giving it new life by doing kind of like this quarterly update.
Cool. Thanks, Chris.
Andrew, thank you again for your time. And now I want to introduce Headset CEO and co-founder Cy Scott. Cy, appreciate you taking time and talking with us today. I always enjoy our conversations because they are just so chock filled with really interesting nuggets. So let's talk about Ohio. As we talked about, as we briefly spoke before we got on the call, is really that right now it's the only state in play as we know it. So let's talk about Ohio. What you expect to see in Ohio, and I'll jump in and ask you some questions as you present.
Sounds great. Thanks, Chris. Happy to be here. We've worked with MJBiz for a lot of years. I can't keep track at this point on the Factbook, and we provide a lot of interesting data. And I'll kind of describe how we get that data. But when we talked about this webinar, I was trying to think about, where could I provide the most value? There's a lot of information in that Factbook. It's a big industry and a very nuanced industry. But really thought that given 2024 and the narrative in 2024 for new markets is very much going to be Ohio, I thought it would be good to do a bit of a deep dive on that market. And I don't think the timing could have been any better given the news yesterday that came out with the Joint Committee on Agency Rule Review out in Ohio, approving regulations yesterday for legal adult use sales as early as next month. And I think the previous timeline was going to be June for licensing, and everyone's expecting sales come September. So great timing. Certainly, they made that change just in time for this webinar. I'm sure that the Joint Committee was thinking about us when they made that choice, but great to be here to be talking about that. So real quick on Headset and where we get our data. For those that aren't familiar, we do work with what we consider retail data cooperators directly. So all our data is sourced from retailers and dispensaries in the US and Canada. We have over 3,500 different retail connections across a variety of markets. We do track sales in every market. We provide what we consider market intelligence, so data on a full market measurement in about 20 markets in the US and Canada. Ohio is one of those markets. We cover the medical side today, and we'll cover the adult use side come next month when it comes online. So that's where our data comes from. And for talking about Ohio in particular here, we wanted to, look at kind of what to expect. There's some good markets that are a proxy, but I did do a bit of a deep dive on Maryland for that reason, and I'll talk about why. But before we get into that, right now, Ohio's average about 40 million in monthly sales. Sometimes higher, sometimes lower, just kind of depends on the month. And in general, when we see a market switch from medical to adult use, you'll see a 2 to 3x increase in sales, which would put Ohio on a 1 to 1.5 billion annual run rate right out of the gate. And that's, I would say, quite conservative. I certainly expect it to be a bit more based on what we're seeing in other markets, but conservatively, probably about 1.5 billion here, all in adult use and medical. There's over 100 active
Inside, let me just jump in here. Ohio is also interesting because if you just look at the other states that it borders, I believe Michigan may be the only state that it borders with an AU program right now. So there is a possibility that you keep, a lot more of those sales in state, so to speak. And even if you're looking at Michigan, the top tier of Ohio, Northern Ohio, is not, there's only, I think Cleveland is up there, but there's not too many populated cities up there either. So that may also keep more folks within the state, which I think, Michigan itself has benefited from that.
Yeah, that's right. And actually, I do have a slide on Michigan kind of to point out the impact there. But Ohio is, geographically interesting. So yeah, here's the Michigan slide. When you look at where Ohio sits, so Michigan is about a $3 billion market right now, a little over $3 billion market in 2023. And there you have Wisconsin and Indiana and Ohio right now, nearby with either no cannabis or medical cannabis, right? And so you get in Michigan a lot of Ohio population that will commute in. Toledo, Ohio, fourth most populous city in Ohio, about 270,000 people. It's just minutes away from Michigan right now. Big cities like Cleveland, about 2 hours, a bit of a drive, but not too terrible. But then Indiana as well. So not only are you going to maybe lose some of those Ohio consumers that are purchasing, but Indiana residents, particularly those that are on the eastern side, southeastern side of Indiana, may start choosing to go to Ohio, versus commuting to Michigan. So this will impact Michigan sales. Michigan continues to grow as a market, and a fair amount of that. I don't have a slide on this, but when you look at kind of the ratio of population of county to the impact they have on total sales, the southern kind of section of Michigan kind of over-index on that ratio, right? It's not necessarily driving the most sales. Areas like Detroit, highly populated areas, Ann Arbor, are doing a lot of sales. But when you look at the ratio of population to sales, it definitely is over-indexed on the South. So certainly that will get impacted by Ohio legalization. But I do want to talk about Maryland. Maryland's a great close proxy. Maryland rolled out just about a year ago. It was July of 2023. For 2023, Maryland did $800 million in full year sales. So that includes half the year medical, half the year adult use. It's about 100 dispensaries, give or take, that are active at the moment. More licensing is coming right now, and that matches up pretty nicely with where Ohio is, about 100 or so, dispensaries active, give or take. So similar on the coverage. Where it differs is population. This says Maryland, but it's supposed to say Ohio. Population is less than Ohio. Maryland is about half the population of Ohio. And as you just mentioned, geographies are very different. Maryland is the East Coast, kind of, south. And then you've got, Ohio, which is, a big Midwestern state, in the first, I think, Midwestern state when you're moving from the east side, and surrounded by, not only those states that we talked about with Michigan, but you've got Kentucky, you've got West Virginia, you've got Pennsylvania, and certainly Maryland shares, borders with places like West Virginia and Virginia that have, some medical, but it's big geography, and, there is probably going to be pull into Ohio from some of those markets as well. So Maryland's a good close proxy. I want to emphasize, nothing is perfect. It's not always apples to apples, given some of the nuance, the different operators that are there, the different rules that exist, geography, population, so on. But it's one of the better ones, because some markets like New York, basically throw out the medical framework and reinstitute an entirely new adult use program from scratch. And that is different in Ohio. Ohio is going to be pretty turnkey, as far as I understand it, where the existing medical operators are going to have dual use licenses. And that looks a lot like Maryland. That's going to look a lot like what Florida has as far as legislation. Now, this is all subject to change. Ohio, if you guys all remember, post legalization, there was a lot of activity in the state legislature to try and change the rules. I don't think anything actually, got through as far as like big structural changes in in the space, but it will, that could very well happen, which will obviously impact a lot of these projections. But kind of based on what we know today, that's just kind of where we see them land. So this is Maryland data, and this is what happened in July. So the big takeaway here are baskets or transactions. You know, when you go up and you purchase your cannabis, that's a basket. Baskets are up almost 3 times, 178% increase year over year, looking at April to April of this year. So the most recent complete month of this year versus, you know, the same time a year ago where it was just medical. So almost 3 times. At the same time, the total receipt value, so the total dollar amount of that basket actually went down about 20%. And I'll talk about kind of pricing dynamics. Pricing is a bit up versus the medical market. But what's happening is like people are just putting fewer items in the basket, but coming back more frequently, or, you know, more people are purchasing, given that there's no barrier with like medical and having to have a doctor's recommendation or anything like that. So if we just take this math, this kind of fuzzy math here, and say, okay, we're going to almost triple our basket size and we're going to bring our receipt down 20%, that would get Ohio to $85 million a month run rate, which is, you know, double where they're at, and that's, you know, conservative. But I think that there are some things that make Ohio unique, where we're going to see a bit more. You know, population, you know, being one of those big ones. Ohio also is quite unique in a category dynamic perspective. And what do I mean by that? So no pre-rolls, which is, you know, a unique market compared to Maryland, or compared to pretty much every other adult use market. Again, this may change. It may have already been changed. I tried to sift through some of the recent headlines with the Joint Committee on if they did change any of this. I didn't notice anything. So in the Q&A, if someone has information, I'd love to hear that. But right now in the medical world, there are no pre-rolls. And then there's this concept of whole day units, which is kind of a funny term, funny to me anyways, on the amount of cannabis that you're, you know, supposed to consume as a patient. And it's funny because I feel like it really varies on, you know, patient condition and so on. But this impacts package sizes. So in most markets, the top sales of package size by unit count is 8, so 3.5 grams. And in Ohio, it's 14.15 grams, which seems like a very arbitrary number, but it has to do with whole day units. So this is equivalent to 5 whole day units. And I think you can have 45 or maybe 90 whole day units at any given time as far as the maximum amount of cannabis you can have. And that's for flower, and it varies for things like concentrates, right? For edibles, you see 110 milligrams is the most popular package size versus 100 milligrams. So also, you know, just kind of a very arbitrary package size, and some of this will change, but this is interesting, and it does impact pricing. And I've got a slide we'll jump to in a second here on pricing. But I just want you to remember when we talk about pricing that you know, average item pricing is based on these types of units. And when you have sales of flower, the most units going at 14.15 grams versus the rest of market at 3.5 grams, you're definitely going to be seeing you know, a higher average price point, right? Because just more units, more volume is moving, and those are generally more expensive. So some unique category dynamics that may impact kind of these projections for Ohio. Next, I want to talk about the consumer makeup. This one is pretty intuitive, I feel like, and just kind of like an obvious one, but it's nice to see the data. And so this is you know, the current consumer in Ohio versus the current consumer in Maryland. And Ohio definitely skews to an older demographic. So when you look at Ohio and you look at baby boomers and you look at Generation X, it's that dark blue bar there. It definitely over indexes compared to Maryland, where you see Maryland is, you know, roughly 13-14% baby boomer sales, almost 25% to Gen X. For Ohio, it's well over 30% to Gen X and well over 20% to baby boomers. So over 50% of sales are going to Gen X and up as far as age. And you know, it's quite lower than that when you look at Maryland. So what's going to happen, what we see happen in every market, is it just skews younger, right? So the younger audience now has access. You know, Gen Z, it's a handful of age groups in there that are 21 plus, but they're going to get access to cannabis without having to go through the medical program directly. And so we may see, similar trends, and it should start to normalize where you see some of the older sales dropping as share of sales moves towards millennials and Gen Z. And last but not least, I want to talk about pricing. So, average item pricing, what we saw happen in Maryland was this jump up. It was almost 20% when you compare it to earlier in 2023. What I believe happened was, as Maryland was gearing up for adult use and kind of knowing that this demand was coming, costs started going up just in the medical program as suppliers, were working through, knowing that, July 1st, things were going to go live, just costs kind of went up and that got passed on to the consumer. And then when adult use happened, pricing jumped a little bit, and then it's been on a slow decline down, kind of getting closer to where we were before adult use started in Maryland. Ohio, has been on a downslope, and again, here's average item price. This is skewed not only because of the package size that we were talking about, but also no pre-rolls. Pre-rolls on a per unit basis are generally the lowest average item price product, and they move a lot of units. And so when you don't have that in the data set, you're going to have a higher average item price. So that's why, it looks so out of band compared to Maryland. But if you just kind of think about the trend lines, I could see, given that, we're going to be opening with the existing doors, given that there's going to be so much demand in a state with a population of 11 million people, the seventh most populous state in the US, there's going to be a lot of demand. And given this is right around the corner, production, everyone thinking it's going to be gearing up for September. I'm not sure where supply is going to be in Ohio, but given, there's not a lot of heads up here and you're going to open the floodgates, I could see pricing jump up, that 20% near term, right? So we may see kind of that rebound. It has flattened out a little bit here at the beginning of the year, kind of rebounded, but I could see this kind of climb. So these are just some things we're looking for, for Ohio. I think big picture, we're looking at a $3.5 billion market. If it's $1.5 billion, that slots us in right after Massachusetts. So it would be the sixth highest selling market. If we're talking about a $3 billion market, you're looking at, Michigan. It could be, the second largest market in the US at maturity after California, ahead of Michigan, maybe third if Florida goes this year. And we see, a $3 billion market come out of Florida conservatively, I think. But, top two or three as far as rankings long term. So it should be really exciting market. I hope everyone's excited. It was so great to see that headline yesterday, and I'm looking forward to just tracking this thing and seeing where we land.
This is I want to introduce our next speaker, Viridian Capital Advisors Managing Director, Frank Colombo. Frank, it's great to have you here with us. We're definitely excited to hear about what Viridian is seeing out there. Maybe let's start with the capital markets. It is as dry as they can possibly get. So I think that'd be a good point to start off with, and maybe talk about how rescheduling could possibly shuffle the cards, so to speak.
Sure. Great to be here. Thank you. At Viridian, we like to think that we are on the kind of the boundary between transactional data and fundamental data. We have, I think, the largest database of deals going back to 2014, spanning debt, equity, and M&A deals. But more recently, we've been more focusing on valuation and credit data. So we try and bring all those three areas together in our work. And we enjoy being a partner with MJBiz. My first slide here talks about the capital markets in cannabis. Get that one up. There you go. This slide looks at capital raises in what we call the cultivation and retail sector. We break the market into 12 different sectors, and cultivation and retail is the sector that has all the licensed operators. It's the biggest sector. Usually accounts for somewhere around 50 to 60% of overall capital raises. The other sectors are things like software and ag tech and the financial companies and hemp. We've even rolled psychedelics into our mix, but this is the largest. And what you see here, going back to 2020 on a quarterly basis, is the sea change here. 2021, the orange bar was equity deals. It was the biggest year on history for equity, but strangely, it was also the biggest year in history for debt, the blue bars. In fact, 5 out of the 10 biggest debt and equity issues ever done in cannabis were done in that year. So it was a little bit of an anomaly year. But as prices started to cave, and we all have felt and seen this, the financing for this sector has changed. You see the blue bars dominate. And so more than 80% of all the capital that's been raised since 2022 has been in the way of debt. So that brings up an interesting point here. You see in 23 and 24, the market is kind of ground to, if not a halt, then kind of a freeze. And personally, I think this has a lot to do with deregulation. In 23, it was, at the beginning of 23, it was the failure of SAFE, and thinking maybe the SAFER Act will come back. Beginning in August, when the HHS announcement happened, it's rescheduling. And all of these potential market-changing impacts have basically put the capital markets into a deep freeze. One of the reasons you can just think about being a CFO of a company and saying, gee, do I want to go out and raise equity now? Well, the answer is no, of course you don't, because you have this expectation that 2 months from now, your stock may be double what it is now. So why would you want to sell stock now? And that is pervasive. It goes to the investor side too. When I see a company wanting to raise equity now, my first suspicion is, wow, they must really need the money, because why would they raise money now? So all of this promise of rescheduling, changes in legislative has had a perverse effect of actually freezing the capital markets. Now, the other thing that is interesting, I think, is as this shift has happened to debt dominance, the leverage of the MSOs has gone up. And we're now at the point where, and we'll have a slide a little bit later that shows how far this has gone, to the point where, a lot of the MSOs are, in my view, over-levered. And so that's also had a little bit of a chilling impact on capital raises. Although I will say that this week, we have $83 million worth of new debt issues this week. So it's changing. I think the debt providers, the debt capital markets are reopening and on the promise of rescheduling, and maybe just on the promise of the fact that the companies are keeping the tax money. They're not paying it. Whether or not they're expensing it, they're not paying it. So the next slide, moving on to the next slide, shows where we've come and where I think we're going to go in terms of valuations based on all this. The furthest bar on the right is where we were as of last Friday. And this is looking at the 11 top MSOs, their enterprise value compared to the next 12 months EBITDA. And you can see that, we are up significantly from when, the August 30th announcement by the HHS that they were recommending rescheduling. We're up about 38% from there. But since the day of the DEA kind of confirmation that that's the direction they were going, we've drifted a lot lower. Now, you might, wonder, why is that? I mean, why? It seems like, rescheduling was announced and nobody cared. But I think MJBiz has done a lot of good work about pointing out the uncertainty of timing. So when will this really be in effect? Will it really even happen in this election cycle before a new administration takes place? And there's other concerns as well. But fundamentally, we still think that if you look at all these past legislative events or regulatory events, you can get an idea of where should we go to. And in my view, rescheduling, if you look at the Schumer-Booker bill, which is the third bar from the left, that bill, which was a full legalization, admittedly, bill, but it was basically dead on arrival. Nobody ever thought that that thing had a chance from the moment it was announced. And yet multiples were 15.7 times back then. So could we go to that? Absolutely. And I think we will, over time, particularly if some of the other shoes drop. This is a unique period in time where we have all these catalysts coming together. We have, obviously rescheduling. We've got the SAFER bill still out there lurking, although personally and institutionally, we give it low odds for this year. But there's also the Schiller Boys lawsuit. There's the Garland memo. There's all these potential catalysts that if you get one or more of them to hit, we still believe that where we're going to go is back up to to the 15 times or higher. Personally, I'm skeptical about ever hitting the 24 times again, simply because that was a different era. It was an era with lower rates, which causes lower values. It was an era of higher growth in the industry. It was an era before the terms wholesale price compression were quite on the tip of everybody's tongue in this industry. So whether we get back to there or not, I'm skeptical, but I feel like we could get back to 18 times or 15 times at least. And the implication of that comes into this next slide. This slide looks at leverage versus valuation two different ways. The graph on the left is kind of the traditional way of looking at leverage. The bottom axis is adjusted net debt to EBITDA. Adjusted meaning I add in leases. I also add in any taxes more than 90 days worth. I count as debt. And obviously I subtract out cash. So that's what that measure is compared to projected 24 EBITDA. And you can see it's all kind of a big, tight cluster there. But importantly, 11 out of the 17 companies in that chart are over 3 times. And if you talk to lenders, what you're going to hear over and over again is 3 times is kind of the magic number for maximum sustainable debt in a 280E environment. Now, I think if you run the numbers and try and say, well, what happens with 280E gone? It surprisingly doesn't shift as much as you might think. It goes up to 4.5, maybe 5 times. But the key thing isn't really interest coverage, it's debt payback period. And what I really think is a better way to look at this situation is the graph on the right. This is my preferred way of looking at leverage in the industry, and it goes back to the years I spent running high yield research at UBS and before that. Bringing in market cap. How does the leverage of the company compare to its market cap? And here you see something really interesting. That measure divides the universe into 2 groups. The group over to the left, where the market is basically saying, yeah, these companies, many of them are highly levered on an EBITDA basis, at least near term, but we think that they're going to be able to grow out of their problems without having to crush their stock in some kind of a purgative, debt to equity exchange or some kind of rescue financing. Whereas the companies on the right, I believe the meaning of this graph is those companies, the market has some question and some doubt as to whether these companies are going to be able to de-lever their capital structure without giving away the store, without having a really highly dilutive equity issue or a refinancing debt issue that has to give away lots of warrants, a lot of equity coverage and whatnot. So I think this is one of the biggest stories in capital markets coming up over the next year and really leading all the way into 2026, where we see the next huge bubble of maturities coming up, is this movement of how quickly and what method do these companies use to re-equitize their balance sheets. And as from my point of view, that's the pressing need here that we see, is this need to re-equitize. So go to the next page. One of the impacts that I also see happening from this this extra cash that the MSOs are going to have, extra earning power as well, is a bump in M&A. Now, admittedly, I've been saying this since the beginning of the year, and so far I've been wrong. I'll admit to it. We have year to date about $130 million worth of M&A deals. That's down from $860 million the year before. So, you know, and M&A is clearly off to the lowest start that it's been ever, at least going back as far as I have data. So M&A coming back is coming from a very, very low level. But this graph is one of the reasons why I think it's going to happen. And the black line there shows the valuation metric difference, enterprise value to next 12 months EBITDA, for the largest companies, the tier 1 MSOs, versus the green line, or I mean the next line down is the small company. The yellow line is the smaller tier 2, tier 3 companies. So that gap, that valuation gap, is a measure of how accretive an acquisition could be. Let's just think about it this way. Like, if you're trading at 10 times EBITDA and the person or the company you're buying is trading at 5 times EBITDA, then that deal is automatically going to be an accretive acquisition. It's going to look good on your books. It's going to improve your situation. And what we've seen over time is, in periods where the market is marching upward, these gaps widen. So that makes these deals where big companies buy small companies more and more attractive. Now, I also think that there's just this overhang of what I call tired operators, you know, people that have been fighting this fight for the last 5 years, and it just seems like rolling the stone, the proverbial stone, up the hill and having it roll right back over you on the way down. So there's quite a bit of that out there. There's people who are companies, managers, who are ready to take a little bit of a better price based on this, hopefully, log rolling effect of rescheduling, and move on. So I think that we will see increased concentration as well. More M&A will lead to more consolidation. That's kind of a lightning rod in this industry, because there's a lot of people out there that think the big MSOs are too big already. But the reality is that the largest MSO is still a very tiny company in the scope of American industry. So I think the big are going to get bigger. We've seen, conference calls for this first quarter where companies like TerraSend have basically telegraphed this idea that, yeah, we're out on the hunt. And I think that's going to start to happen in short order. So with that, I will give it back to you, Chris. Oh, wait a minute. I got one more slide here. One more slide. This is a measure of stock liquidity. This is another big problem in the cannabis business. And I referenced the top line, which is the red line, is a measure that I call days to trade the market cap. So if you look at that farthest right one, the 549 days, that means that the top 10 MSOs here have an average of 549 days that it would take to trade in the stock market, to trade their market cap. A way to think about that is, if you're an investor and you buy a 5% position in a stock that looks like that, and you want to get out, it's going to take you around 100 plus days to get out. And that's one of the things that I don't think rescheduling fixes by itself, but it pushes us a little bit closer towards this time where you not only get 280E relief, but the next kind of holy grail of cannabis, which is uplisting. We're not there yet, and I don't think rescheduling gets us all the way there, but it is a push in the right direction. So back to you, Chris.
Thank you, Frank, for that fantastic overview of what's going on in the public markets. I'm going to invite Andrew back to the table. I'm going to invite Sai back into the conversation. We're going to open this up just for some general Q&A from the audience. While I have just some ideas fresh in mind, Frank, I just want to talk about, maybe ask you, about this potential M&A situation with MSOs. Maybe the types of companies that they're looking for, how do they value, individual storefronts? Are they looking at more of a market blast, or like what we saw what Planet 13 did, where, they're acquiring a bunch of stores, in that case, Florida? And then also how this debt situation may affect deals. Does it make it more expensive to do deals right now?
Yeah. First off, one of the big issues with the big companies doing these M&A deals is their map. They already are in a bunch of the territories that the companies they were acquiring are in as well. And that was part of the problem. If you think back to the Cresco Columbia Care deal, is there was this huge amount of overlap, and that causes issues because you have to sell those overlap states. So one of the things that is interesting is states like Missouri, where there's no overlap with the MSOs. There's virtually no MSO presence there. And so that is a natural state for them to look to get into, because they don't have this issue with overlap. But then you run into the next thing, which is, suppose you are one of the top MSOs, a GTI, a Curaleaf, whatever, and you're looking to enter a new state. It's very hard to enter a new state just from zero. Like let's buy one or two dispensaries. They want to have scale, so they're looking for companies, an acquisition that could give them kind of instant scale, and then build from there. But so they need larger acquisitions, and so that is a tough combination. Like finding
there's a lot of check boxes,
states where you don't have overlap, and finding scale to be able to get in. And I think that is part of what slowed down M&A so far. With regard to the debt situation, I think that how that impacts is, over time, when prices really dropped off the cliff in cannabis, what you saw is a move away from using stock as an acquisition currency. It just makes sense, right? Your currency is debased, so you don't want to use it as a currency. So, but what happened? It wasn't as though companies all of a sudden started adding more cash into these deals. They didn't. What happened was they started using more take-back paper, getting back to your point about debt. They started using more seller financing. They started using more earn-outs. They started using other kind of ways to make up the difference from stock, not adding much to the cash, but adding these other kinds of forms of payment. And so, the take-back paper, does it hit their books as debt? Yeah, it does. But it's usually almost like project financing. It's limited to the company you're acquiring. So it's not quite the same. It's really, if you lose that division that you just bought. That's what a default does to you, rather than like bringing down the whole house of cards. So I don't think that that's going to be the problem. I think it's more, the overlap issue, the division of, just the very fact that merging companies is very hard to do. Away from cannabis. Cannabis has its own unique problems with mergers because, every state is its own little fiefdom, and you have to understand each state. But even in ordinary American business, most acquisitions or most mergers fail. They do. So, that problem is multiplied when you get to cannabis. So
Great point.
a little
Great point,
hesitation is a good thing.
Yeah, and Sai, I want to bring you back in. So before we lost you there, I asked you about Ohio's medical market and how you kind of see that playing out, especially with the pre-rolls not being part of the mix there. So maybe just talk a little bit about that, and then we'll open it up to some general questions if folks have that are listening in.
Yeah, I mean, you're spot on. Medical markets generally decline as people either move into the adult use category, or the infrastructure for medical, changes, and it can vary on market. I'm in Seattle here, Washington, one of the oldest adult use markets, and there's basically no medical market. I mean, the medical market is kind of a tax-free version of the adult use market. So that's like one extreme. But then generally, yeah, it does decline. So we could expect that same shift to happen in Ohio. I really wouldn't be surprised, especially if things like pre-rolls do become available in adult use. I could see a large sector of the market. I mean, people are buying a lot of flower, as we saw in medical. They have to consume that flower in one way or another. Vaping is one option. Creating your own kind of concentrates another option, but probably people are making their own pre-rolls, right? So if they can jump into the adult use to do that, I could see that happening as well.
Yeah, absolutely. And obviously it was so important just how the legislation was written to begin with. I mean, really, that is kind of the letter of the law right now, because at least from what I've seen, lawmakers did not make some of these massive changes that almost kind of taking away the will of the voters. We thought that may happen because their constitution does allow that after a ballot measure, but because there's so much infighting and what we've seen in so many different lawmaking arenas, they just can't get on the same page, even party lines. So Kelly, I'm going to open this up if there's any more just general questions from the audience for any of our presenters here.
We just got a couple questions. There was a lot of great conversation, but Velvet Kavanaugh, she was curious, Andrew, with the companies that were talking about the challenges, did you see any trends on how that changed based on the age of the company? Were they newer companies that were experiencing more challenges versus those that were more long, in larger markets?
Yeah, I didn't really look at that. We basically just took, were they a launch, were they generating revenue, and looked at that. I would suspect that the change happens the longer they're in the industry, obviously, that it's that optimism, a lot of passion around their business. But then once the reality hits of what's going on, that change. So I would imagine it shifts a bit towards the being more pessimistic.
Awesome. Thank you. And the other main question, I think this is for Frank. Mark was curious whether or not some of that market data was, or how much the market is driven by MSOs and publicly traded companies versus non-public operators.
Sure. I don't have a percentage in mind, but we do try and capture both public and private. So this data, with regard to volume of transactions and dollars of transactions, is not just private or not just public, it's private as well. I would, though, say that what we are seeing is a little bit of a trend towards companies not wanting to talk about their deals. We collect data from about 300 different data sources, which include aggregators like PR Newswire. A lot of companies send us feeds directly. We do web scraping. So we try and collect data from a lot of places. But I think there may be, what I've noticed is the private company deals, a lot of times they don't give away full data. They say, we raised $25 million, from XYZ Corp. And that's it. They don't tell you the coupon. They don't tell you the maturity. They don't tell you if there was warrants attached to it. And why is that? Can't say for sure, but my intuition is that in this kind of rugged financing market, people are taking terms that they're not exactly excited to go announce to the market. So, I think that is as an impact, in terms of numbers though, I think we probably, to the extent we miss deals, we miss more small private deals than we certainly don't miss virtually any, public company deals, but small private deals where they just don't announce to anybody. They kind of keep it under the carpet. Yeah, we may miss some of those. Hard to say how much on a percent basis.
Well, thank you so much. I really appreciate everybody joining us today. We will follow up with an email with some more information. We will include the information that you received today in that email. Chris, any closing thoughts from you before we sign off?
Just want to thank everyone for joining the panel. You guys did a fantastic job. Really a lot of great information, a lot of tidbits, a lot of things to think about as we kind of go further into the year. I just want to thank you guys for your time.
Thank you. Have a great day.
Thanks.
Thank you.
Thanks.
Thank you.